Have you ever wondered how to use the power of MACD to forecast the market? MACD is an amazing indicator that can reveal the secrets of price movement. By following a few simple steps, you can learn how to accurately identify a 5-wave pattern. These patterns are the key to trading success and enable you to predict market trends like a seasoned trader.
Step 1. Now it's time to identify 5 waves using MACD. To start finding 5 waves on MACD, we check MACD histograms. Here we are looking for divergence. Divergence occurs when the price of an asset and the MACD index move in opposite directions. For example, if the price is rising but the MACD is declining, it may indicate weakness in the uptrend and a bearish divergence. Divergences can be powerful signals for traders and help them predict the end of a trend. Step 2. According to the 2 waves that we found in the previous step, we consider the first wave as the hypothetical wave 3 and the second wave that created the divergence as the hypothetical wave 5. In this case, there must be 2 waves 2 before wave 3 so that these waves we consider hypothetical wave 1 and hypothetical wave 2 respectively. Step 3. In order to detect wave 1 from MACD, we first consider the previous trend. Considering that this is a downward trend, it can be seen that the climbs that took place and MACD penetrated above the zero line are very weak. A horizontal line at the end of the biggest climb that occurred we draw, as you can see, where the rising wave 1 started, it crossed this line and created a strong upward histogram compared to the previous rises, which can be a motivational sign of wave 1. Step 4. Now we will examine these 5 waves on the chart itself. We know that according to Elliott's theory, every motivational wave is followed by a corrective wave and they follow Elliott's 5-wave rules. For example, wave 1 starts with a bullish wave, while wave 2 is a corrective wave that moves in the opposite direction of wave 1. Wave 3 should not be the shortest wave between waves 1 and 5, and wave 4 should not break into wave 1. By checking these rules with our desired 5 waves, if our hypothetical 5 waves matched the rules, then the 5 waves we recognized were correct, and after these 5 waves we should wait for a correction. Step 5. Now let's go deeper and talk about MACD itself. MACD indicator is a popular technical analysis tool that consists of 2 lines, MACD line and signal line. MACD line is the difference between 2 12-period and 26-period EMA. The signal line is also a 9-period exponential moving average of the MACD line. These lines are used to identify momentum and price trends. Step 6. After identifying the 5-wave patterns, now is the time to use the MACD to confirm the 5-wave completion and trend reversal. Notice if there are intersections between the MACD line and the signal line. A signal is generated when the MACD line crosses the signal line. If the MACD line crosses from the bottom to the top, it is a buy signal, while crossing from the top to the bottom is a sell signal. These signals can help confirm or reject wave patterns. As you can see, after 5 waves, a signal was issued by the MACD lines, and after that the trend has reversed. Pay attention to these points when using this method. To increase the accuracy of your analysis, you can use other complementary tools. Fibonacci indicators, moving averages, and oscillators can help confirm or reject wave patterns. These tools can help you make more informed trading decisions. As you know, practice makes perfect. Counting waves using a MACD is a skill that improves with time and experience. Examine the various charts and try to identify patterns. With continued practice, you will gradually become proficient at spotting patterns and using MACD to confirm them. Remember, counting Elliott waves using MACD is a powerful tool in technical analysis. By following the steps explained in this video, you can improve your skill in identifying 5-wave patterns and make your trades more accurate. So, check the charts, practice and trade with confidence.